Marcus stared at his tax return and felt sick to his stomach. Not because he owed money, because of what his new accountant just showed him. For 3 years straight, he'd been doing his own taxes. Keeping it simple, taking the standard deduction, figured it was no big deal. His accountant pulled up the numbers. "Marcus, you donated to charity every year, right? And you worked from home 2 days a week. And you drove your personal car for work sometimes." Marcus nodded. "You left about $4,700 on the table per year for 3 years. That's over $14,000 you could have gotten back." Marcus literally put his head in his hands. "Bro, why didn't anyone tell me this? That's exactly why we're making this video." Hey everyone, I'm Kieran Naz, and let's be real for a second. Taxes are confusing as heck. The IRS tax code is literally over 74,000 pages long. Nobody got time to read that. But here's the thing that should fire you up. According to a 2024 study by the Government Accountability Office, Americans overpay their taxes by nearly $1 billion every year. Billion with a B, most of that money comes from regular folks like you and me missing deductions. I'm going to walk you through the tax deductions most Americans miss with examples so you can stop giving Uncle Sam money that's rightfully yours. Let's get into it. First, let me show you how big this problem actually is. The IRS reported that approximately 30% of taxpayers who file itemized deductions make errors that cost them money, and here's the kicker. Most of those errors are from missing deductions, not claiming ones they shouldn't. People are literally leaving their money with the government because they don't know what they can claim. A 2023 NerdWallet survey found that 61% of Americans are afraid of making tax mistakes. So they play it safe. They take the standard deduction. They don't dig deeper. And that fear, it's costing them thousands. Here's the deal. For 2024, the standard deduction is $14,600 for single filers and $29,200 for married couples filing jointly. If your itemized deductions add up to more than that, you're leaving money on the table by not itemizing. But even if you take the standard deduction, there are above-the-line deductions that can still save you money. We'll get to those. David Batch, author of The Automatic Millionaire, writes that the average American family wastes between $2,000 and $5,000 annually on tax, mistakes, and missed deductions. That's a vacation. That's paying down debt. That's an emergency fund. Instead, it's just gone. Poof. Marcus was one of these people. He thought his taxes were simple. W-2 job. Nothing fancy. But simple doesn't mean you're not missing money. All right, let's get specific. Here are the deductions most Americans miss. Deduction 1. Home office expenses since COVID. Millions of Americans work from home at least part-time. If you're self-employed or have a side hustle, the home office deduction is legit. Here's how it works. You can deduct a portion of your rent or mortgage, utilities, internet, and home insurance based on the percentage of your home used for business. The simplified method lets you deduct $5 per square foot of home office space up to 300 square feet. That's $1,500 right there. IRS statistics from 2023 show that only about 18% of eligible taxpayers claim the home office deduction. Why? Because people think it's a red flag for audits. That's actually a myth. As long as you have a dedicated workspace used regularly and exclusively for business, you're good. Marcus had a home office for his eBay side hustle. He never claimed it. 3 years of $1,500 deductions, gone. Important note, if you're a W-2 employee who works from home, this deduction doesn't apply to you anymore since 2018. It's only for self-employed folks and business owners. Deduction 2. Medical and dental expenses. This one's tricky, but it can be huge. You can deduct medical expenses that exceed 7.5% of your adjusted gross income. If you make $60,000, that threshold is $4,500. Any medical expenses above that are deductible. What counts? Doctor visits and co-pays, prescription medications. Health insurance premiums you pay, out-of-pocket dental work, vision care, and glasses. Mental health services, travel to medical appointments, gas, parking, tolls, medical equipment, long-term care costs. A 2024 H&R Block analysis found that the average American family spends over $5,800 annually on out-of-pocket healthcare costs. If you had a rough health year, those expenses might be deductible. Marcus's wife had knee surgery last year. Between copays, physical therapy, and prescriptions, they spent over $8,000. They never thought to deduct any of it. Deduction 3. Charitable contributions. Most people know you can deduct cash donations to charity, but they miss a ton of details. First, non-cash donations count too. Those clothes you dropped off at Goodwill? Deductible. That old furniture you donated? Deductible. The car you donated to charity? Deductible. According to Intuit TurboTax data, the average household donates approximately $500 in non-cash items annually, but only 1 in 5 actually claims the deduction. You need to document it. Get a receipt from the charity. Take photos. Keep a list of what you donated and the fair market value. Pro tip: It's Deductible is a free tool from TurboTax that helps you value your donations. Second, out-of-pocket expenses for volunteer work are deductible. If you drove your car for charity work, you can deduct 14 cents per mile. If you bought supplies for a charity event, that's deductible. If you paid for parking while volunteering, deductible. Marcus coached Little League for 3 seasons. He drove to practices, bought equipment, paid for snacks for the team. Never claimed any of it. Deduction for state and local taxes. Salt, this one's capped, but still valuable. You can deduct up to $10,000 in state and local taxes. This includes state income taxes and property taxes. If you live in a high-tax state like California, New York, New Jersey, or Illinois, you're probably hitting that $10,000 cap. The Tax Foundation reported that nearly 40% of itemizers claim the SALT deduction, but many people in moderate tax states don't realize they qualify. If you're paying $5,000 in property taxes and $3,000 in state income taxes, that's $8,000 in potential deductions you might be missing. Deduction 5. Retirement contributions. Here's a big one that's literally free money. Traditional IRA contributions are deductible, up to $7,000 per year in 2024. If you're over 50, it's $8,000. If you contributed to a traditional IRA and forgot to claim the deduction, you just gave away free tax savings. But here's what people really miss: self-employed retirement plans. If you have any self-employment income, ASEPIR lets you contribute up to 25% of your net self-employment earnings, maxing out at $69,000 in 2024. Marcus's eBay side hustle made about $12,000 last year. He could have put away $3,000 in a SEPIR and deducted every penny. J.L. Collins writes in, "The simple path to wealth that tax-advantaged retirement accounts are the closest thing to free money in the financial world." He's right. Deduction 6. Student loan interest. If you're paying off student loans, you can deduct up to $2,500 in interest paid each year. The beautiful thing: this is an above-line deduction. You can claim it even if you take the standard deduction. According to the Federal Reserve, over 43 million Americans have student loan debt, but IRS data shows only about 12 million claim this deduction. That means millions of people are paying student loan interest and not getting the tax break they deserve. You should get a Form 1098-E from your loan servicer showing how much interest you paid. If you didn't get one, log into your loan account. The info is there. Deduction 7. Educator expenses teachers. This one's for you. If you're a K-12 teacher, you can deduct up to $300 for classroom supplies you bought with your own money. And let's be honest, every teacher spends way more than $300 on their classroom. It ain't much, but it's something. This is another above-the-line deduction. You get it even with the standard deduction. The National Center for Education Statistics found that 94% of teachers spend their own money on supplies, averaging about $479 per year. $300 of tax deduction isn't enough, but don't leave it on the table. Deduction 8. Side hustle and gig economy expenses. This is where the money gets real. If you drive for Uber, deliver for DoorDash, sell on Etsy, freelance, or have any side hustle, you have business deductions. Mileage is huge. The IRS rate for 2024 is 67 cents per mile for business driving. If you drove 5,000 miles for your side gig, that's $3,350 in deductions. Other side hustle deductions. Phone and data plan percentage used for business supplies and materials, software and subscriptions, marketing and advertising costs, website hosting, professional development, and courses, home office, as mentioned earlier. A 2024 study by MBO Partners found that 72 million Americans did some form of freelance or gig work, yet IRS data suggests less than half properly track and deduct their business expenses. Deduction 9. Job search expenses for self-employed. This one changed in 2018. If you're a W-2 employee, job search expenses are no longer deductible. That sucks, but it's the current law. However, if you're self-employed and looking for new clients or contracts, those expenses are still deductible as business expenses. Portfolio printing, website hosting, business cards, travel to client pitches, it's all legit. Now, let's talk about mistakes that make these deductions disappear. Mistake 1. Not keeping records. No receipts equals no deductions. It's that simple. The IRS requires documentation. If you get audited and can't prove your deductions, they get disallowed. Use an app like Expensify or just a folder in your email for digital receipts. For cash donations, keep bank statements or a written acknowledgement from the charity. For non-cash donations, take photos and keep a detailed list with values. Marcus had donated thousands over 3 years, but no receipts, no photos, no documentation. When his accountant asked for proof, he had nothing. Mistake 2. Confusing deductions and credits. A deduction reduces your taxable income. A credit reduces your actual tax bill. Credits are worth more, dollar for dollar. Make sure you're claiming both. Common credits people miss: child tax credit, earned income tax credit, American Opportunity Tax Credit for college, lifetime learning credit, child independent care credit, savers credit for retirement contributions. The earned income tax credit alone is worth up to over $7,000 for families with 3 or more kids. Yet the IRS estimates 1 in 5 eligible taxpayers don't claim it. Mistake 3. Always taking the standard deduction. The standard deduction is easy, but easy isn't always smart. Run the numbers both ways. Every year, your situation changes. Big medical year, itemize might win. Bought a house? Mortgage interest might push you over. Made lots of charitable donations? Add it up. If your itemized deductions beat the standard, you're losing money by not itemizing. Mistake 4. DIYing when you need help. Look, I'm all for saving money, but sometimes professional help pays for itself. If you have a side hustle, investment income, rental property, or complex situation, consider a CPA or enrolled agent. A 2023 National Society of Accountants study found that the average taxpayer who uses a professional saves approximately $1,200 more in deductions than the cost of an accountant, usually $200 to $500 for moderately complex returns. The math works out. All right, here's what you need to do. Step 1. Gather last year's returns, pull your last 2 or 3 tax returns. Look at what you claimed. Look at what you missed. If you find missed deductions, you can file an amended return going back 3 years. You might still get that money back. Marcus amended his last 3 returns. It took his accountant 2 hours. He got back almost $8,000 in refunds. Step 2. Start tracking now. Don't wait until tax season. Start tracking deductible expenses today. Create a system, a folder for receipts, a mileage tracking app if you drive for business, a spreadsheet for charitable donations, a note in your phone for medical expenses. When tax time comes, you'll have everything ready. Step 3. Calculate both options before filing. Run your numbers for both standard and itemized deductions. Free software like IRS Free File will do this automatically, or use TurboTax, H&R Block, or similar software. See which one saves you more, then choose accordingly. Step 4. Consider professional help. If your return is getting complex, invest in a professional. Ask friends for referrals. Look for CPAs or enrolled agents who specialize in your situation. The money you save usually far exceeds the cost. Here's where Marcus is today. He amended 3 years of returns and got almost $8,000 back. This year, he's tracking everything: mileage for his side hustle, home office expenses, every donation, every medical receipt. He estimates he'll save at least $3,000 more this year. Money that would have gone to the IRS is staying in his pocket. I'm Kieran Nas, and here's what I need you to understand. The tax code is complicated on purpose. It's designed by lobbyists and legislators, and it's not written to help regular people. But within that complicated code are legitimate deductions that can save you thousands every year for your entire working life. The IRS isn't going to call you and say, hey, you missed this deduction. That's not how it works. You have to know, you have to track, you have to claim, or you can just keep giving your money away. The average American overpays between $2,000 and $5,000 annually in missed deductions. That's insane. That's money for retirement, for your kids' college, for an emergency fund, for actually living your life. Don't let it slip away because you didn't know what to ask for. You know now. Do something about it. Thanks for watching. I'll see you in the next one.